transactions which are very typical in a pharma industry. So in a pharma industry, you will typically have import of APIs, or maybe in a layman's language, you can say these are the raw materials which go into production of the final drugs and all that. There is payment of commission. You have these companies in India which have marketing subsidiaries abroad, so they would be paying them some marketing commission. Clinical trial support services or clinical trial services. There would be certain marketing intangibles. There would be R&D services, royalties, and location savings. So we look at all these transactions in detail as we go along on the slides. And Karishma will take over from location savings and other pharma issues. She'll also speak about manufacturing. To start with, we just touch upon transfer pricing documentation. Transfer pricing documentation is broadly divided into three categories. So how we prepare the documentation is entity related, price related, and transaction related. So as you would see on the slide, any information about the industry in which the particular taxpayer is functioning or the group is functioning, also the profile of the Indian entity, the associated enterprise and of the group is all given in the transfer pricing documentation, which is prepared under Rule 10D, read with Section 92B. There are price related information which is also given in the transfer pricing documentation. So that is about what are the transaction terms, what is the economic analysis as to how the particular transfer price is benchmarked. So I'm sure in the earlier sessions you all must have gone through a few presentations on what is TP documentation and the basics of that, but we just try to put it in a very simple way that these are the three things which must be there in a transfer pricing documentation. The transfer pricing documentation is mandatory if the value of international transaction exceeds 1 crore, and it has to be contemporaneous, has to be maintained for a period of 9 years. Going on to what is the process of preparing transfer pricing documentation, we have just very briefly put down in stages. So the first stage includes pre-project planning. The second is functional analysis or information gathering, wherein you actually go to the taxpayer's office, you try to understand their business, you ask all the relevant questions about what are the functions they are performing, and what are the operation specialities in that particular company. Then you go on to the comparability and the data analysis, wherein we do a search strategy. So we all know there are just two databases like Provis and Capitaline, which we all use. We can also look at if there are any direct comparables which are available. Following that, we do the economic analysis, and finally, when we finalize the transfer pricing documentation, before that we typically have a consultation with the management to ensure that whatever we have captured on the FAR analysis and on the economic analysis, and we have, why we have ruled out certain methods and what methods we have adopted is right, because we don't want to, have surprises later on when the case is being assessed by the tax officers to get some information which we have not basically captured in the documentation. Typically, FAR analysis in the pharma industry, typical FAR analysis. So what would a pharma company, what are the functions that a typical pharma company would perform? To begin with, you can imagine that there will be certain R&D activities. So these functions are like, a laundry list of functions which a pharma company may be performing. It's not necessary that all pharmaceutical companies perform all these functions. Some of them do only manufacturing, some of them do only distribution, some of them have an R&D department, some don't. So this is a laundry list of functions which typically pharmaceutical companies would have. Assets, again, there may be intangible assets, there may not be intangible assets. Tangible assets, of course, like a building or a plant and machinery. So, for example, in a distributor, there may not be any plant and machinery. So we have to look at it based on what exactly the company is doing. We briefly listed down the risks which would be involved. Moving on to the next slide, the steps.
So In the earlier slide, there are 2-3 important functions from a pharma perspective, which becomes important to understand, which is very crucial to document. The first one is the R&D function, and the second one is the manufacturing, primary and secondary. Because in a pharma industry, who is doing the primary manufacturing, which is the main active ingredient, which is the heart of the product, is very crucial to document. So typically in other FAR analysis, you would generally write about manufacturing. But here if you split the manufacturing into active, which is your primary and secondary manufacturing, then that makes it very clear, because your value addition in the pharma industry comes from the primary manufacturing. The secondary manufacturing is mainly only the formulation activity, which is once you get the active, you just need to convert it into a tablet. So that's not a lot of value added activity. And the third important function for pharma, which will be important to explain and which I think she will cover later from an AMP perspective, which is marketing intangibles, is your advertising and marketing function. Because in a pharma industry, if it's a multinational company, a lot of money is spent on doing marketing for new products. And initially the gestation period for products in a pharma industry is typically 5 to 7 years. So a lot of money is spent at that time, and which is why documenting that becomes very important in the pharma FAR analysis.
Okay. Moving on to the steps of conducting function analysis, as we already observed that we need to firstly understand the full process flow in any particular pharma company which we are examining. We need to understand what are the key performance indicators of the company which you are basically. So if it's like a more of an R&D based company, then for them the performance indicators would be R&D based. If let's say it's a manufacturing company, then the manufacturing processes and the quality of medicines manufactured, those would be their performance indicators. So it is important to understand that what exactly is the company doing and what are the main functions of the company. From the assets perspective, you may basically want to map it along with what the functions are being performed. So you may want to look at what are the tangible assets in the company and what are the intangible assets. So typically you can correlate that if a particular company doesn't have many intangible assets, then their margins are likely to be lower, because suppose if they are doing R&D, so they are not actually holding the IPR in the R&D which they are doing. So those kind of things will help you understand whether this company is doing high-end activity, whether it's a fully entrepreneurial company, or whether it's actually working as a contract R&D or a contract manufacturer and things like that. So we will talk about these things when we speak about each and every transaction. But briefly to give you a flavor as to what should be looked into. The risks assumed would be another things which need to be looked into. So what are the key risks which these companies are undertaking? For example, if you just have a marketing company, let's say, so this company would not be actually undertaking any kind of risk. They'll be just getting a commission on the sales which is made. So those companies get a percentage of the sale value, or sometimes they also earn a cost plus markup. So whatever cost they incur, they get that cost reimbursed along with a certain arm's length margin. Okay. There should be basically, it's important to understand that this particular analysis has to be done both for the associated enterprise, which is the overseas entity, whether it's the parent company or the subsidiary, and the Indian company. So you need to plot the functions and you need to see as to what functions are being performed by the parent and what by the overseas company and the Indian company. So it is necessary to understand that which functions are performed by which company to a particular transaction.
Do we need to plot down all the functions which are performed, or is it like core functions which are more value added? That is what's more important.
No, so basically, if you are looking at a particular transaction, you need to, around that transaction, whatever are the functions to be performed or whatever assets are to be utilized, you need to actually plot that, for let's say a production activity or an R&D activity. You need to basically plot down as to, in let's say a manufacturing activity, who is providing the technical know-how, whose R&D it is, who is having the manufacturing process.
Step by step.
Yes, so at least relevant to the transactions. For example, if you're just let's say doing a transaction of manufacturing where you are importing the APIs, then what you need to do is, at least for that particular transaction of import, you need to plot down all the functions. So let's say it's a foreign parent and an Indian subsidiary, which is a contract manufacturer or a licensed manufacturer. The foreign company may be doing many other things or maybe manufacturing many other products, but the Indian company may be manufacturing just one or two products. So at least relating to those two products, you need to plot everything down.
Thanks.
Yeah. So as a result of this, we should be able to characterize as to what is the Indian company, what is the character of the Indian company. So as we go along, we will understand this more, but to characterize the Indian company based on all the functions and the activity performed and and the market in which the company is performing, it leads you to a particular point where you are able to decide that whether the Indian company is taking X amount of risk and what is the kind of profits or margins that the Indian company is maintaining. Okay. Now, all these transactions which we just discussed about, these are the few methods which could be typically used for these transactions. So we have tried to just club these transactions under these methods, like for example, purchase of APIs or sale of APIs, import or and export of formulations, technology use, distribution function, we typically use RPM. For manufacturing, contract R&D, clinical trial services, marketing, contract manufacturing, we use the transaction net margin method. We will look at each of these transactions in detail and what are the typical documentation requirements for each of these functions performed by the pharmaceutical companies. So coming to the first transaction, which is import of APIs, we have taken an example of a company which is based overseas, and it has an Indian company which is doing the manufacturing. So as Karishma already spoke, that the primary manufacturing is the manufacturing of APIs, which is most important. Like the underlying compound or the underlying molecule which is there in any particular product is the most important ingredient, and based on that the product is formed and the effects of the product are known. For example, you have this product like Crocin. So that is so familiar, like you may have many other paracetamols available in the market, but when they use a particular API and the effect of that, so it comes through the the composition of the molecule or the API which is there. So this was a very simple example, but you may look at many other products, and there have been many other cases also on that, which we will discuss later. That the quality of the API, the purity of the API, and how well researched and tried product it is matters a lot in the pharma industry. In this case, the Indian AE is only doing secondary manufacturing, is based on the API, which is the raw material or the compound which they are importing. They are basically manufacturing FDFs, that is the formulations, which is the final product which is consumed. The typical functions and risks of the overseas company are manufacturing and marketing of APIs. They have done the R&D of getting this API to the picture. They have the product liability risk. For example, during the R&D, at the end of a particular research process, if they feel that the product is not effective enough, okay, or it is not giving the desired results, then the basically if the particular exercise of research fails, that liability is also with the overseas company. Once this particular API is approved and it is tested, it is then given to the Indian company for just manufacturing formulations. Indian company would still have some kind of market risk. It would have inventory risk, like if the product goes like if it expires in a particular time, the product is going to stay till 6 months. So if they have inventory, they have lost those inventory, they have to throw it away. They also have forex risk because they are importing these products. What are the typical issues which arise when we benchmark import of APIs? The typical issues which arise are comparability with generic APIs. So these are the two terms which are used in the pharma industry, is the patented or the branded APIs, and patented and branded formulations, or generic formulations. So the patented products are those which are well researched, the purity is good, they have patents or they are patent expired products, but they have been tried and tested. Whereas the generics are similar products. So like you can have a paracetamol from a particular company coming which is actually patented, or it's well researched, the purity is much higher, the quality is much higher. As against that, you may also have a generic paracetamol. So that way, what happens is when there is an import of API by, let's say, Glaxo or somebody, which is actually a patented product, a high quality product, what the transfer pricing officers typically tend to do is they compare it with the APIs which are generally available in the market, the generic APIs which are not branded or patented. So what happens is, in that case, your import price is always going to be higher than the generic APIs which are there in the market. They also try to take, secret comparable data from other pharmaceutical companies, asking them to, furnish what is the import price of this particular generic drug in their company. For example, if some other companies also manufacturing a particular paracetamol, they may go to them and ask them to give, the price of that per kg of that particular API, and they may use that against you. There is basically import analysis and the customs data that is also available freely, like there is the STIPS software, or there is the SIMS software which is available, wherein the product prices are available, and without going into the quality of the products, a comparison is made. What is the suggestive documentation for this? Robust documentation should be maintained to substantiate that the quality of the particular product that is being imported is different, it is much higher. There also needs to be, you can also try to submit the laboratory reports, the technical reports, or all the research which has been done on these products. It is necessary to look at the comparables which are being selected. If you are performing a net margin analysis, then these comparables are also selling branded products, so that more or less the values would match. I mean, the value of the import of the FDI, import of the particular API would also have been researched, and the product price will be that much higher, which we consider the cost of research also into it. You have to make sure that the companies which are in different geographies or which are selling in different geographies, because every particular country has specifications on the drugs and the medicines which are sold in that country. So some countries are very lenient on the regulations, some countries are very strict. So mostly to launch your product in a particular country, the cost is sometimes much higher than the other country. You have to show that, irrespective of the fact that the import, you are importing the pharmaceutical ingredient, the active, at a higher price, but you're still able to make higher profits because you are able to sell it at a higher price because of the brand value. And again, analysis of the custom data can be done by you beforehand, before it gets into the discussion before the transfer pricing officer. The other, sorry. So where external cup is not favorable. So in a particular import of active, there
Can I
will
ask
be.
a question for that? Secret comparables. To what extent is the IT department allowed to use it, and what defense does the SSC have against it?
No, so we are not talking about the secret comparables which IT department allows us to use. We are talking about
when the IT department uses secret comparables, obviously the SSC does not have access to that data. So what is the redress here? Like in Norway they allow it, but certain limited access is allowed to the SSC, and they are given those, without disclosing any names, they are given access to the figures, and they can present their case. So in India,
I guess
what
in
happens?
our country there is no written norm that if somebody has used a secret comparable. For example, they have approached some ABC3 pharmaceutical companies and tried to get information about the prices that they are importing the actives. Okay, it's all depending on how your relationship or how your proceedings are going before the officer.
How do you defend yourself then?
So I'll just just to address that. So the law basically, our Indian law says that if there is any data that the TPO wants to use, he needs to disclose that to the assessee.
Exactly.
So which means when they get this data from other companies, they will first disclose the data to you. So there
Without
is
naming any names.
no with names. With names they give us the data.
Isn't that against the confidentiality?
Yeah, so that is for the company who is giving the data. If they feel it is confidential, then they need to put it in their submissions when they are giving, because when they get a notice under section 133(6), they cannot not reply to it. So there are 2-3 ways. So we also help a lot of our clients replying to 133(6) notices, and in that what we tell them to in the end put is, if there are details like prices, etc., which are competitor prices and confidential information, then in the end ask them to insert a line or a clause or a para which will say that this data is confidential and it should not be shared with anybody. If that is done, then it binds the TPO to not use that data, and once he can't share that data with the assessee, anyway he cannot use it. But unfortunately, what has been happening is 90% of the cases, the 133(6) notices don't have any such disclaimers. So the data is shared with the assessee, and when the assessee is given the data, he has the right to rebut that data. However, in the pharma case, what happens is that the data, even the quality of data that is given. So for example, like she explained, paracetamol, right? Now if there is Glaxo or whoever importing from their A's in UK, they know the full details about that product. What is the shelf life, what is the efficacy, what are the side effects, how does it test on the patient. But when this same data they obtain for a Chinese import from say Cipla, let's assume, they are only asking for from where do you import, what is the price, what is the quantity. That's it. So they don't know the quality, the pharmacopoeia, all these other factors, and which is our redressal or which is our defense that we have when we go up to appeals, to say that this data itself is not reliable for them to use the cup method, because when you say that cup method has to be used, it has to be identical.
It has to be very comparable.
So that is a factual argument you have.
No,
on
because
the
I came
legal
across a case in Norway where the Supreme Court in Norway has ruled that if the tax authorities, without disclosing names, then they can hand over the data and give the assessee a chance to rebut. But they cannot give the complete data because obviously their confidentiality is being affected. So I just thought what happens in India.
Here we also have Right to Information Act. So actually, even if the assessing officer doesn't or the TPO doesn't give us and he uses some data, we have the right to, under the Right to Information Act, ask for that data. Having said that, this is all factual. But let's understand legally what happens, because actually the data that they are using, in addition to these factual arguments, you also need to make a legal argument in your submissions to say that even if he is giving this data is not contemporaneous. Because when I did my transfer pricing study, this data was not available in the public domain, and this data was not available at that point in time. And therefore, he cannot actually use this data because it imposes a impossibility of performance on me, for having used that data to arrive an arm's length price. So in addition to, of course, the factual arguments that you make, you need to make the legal arguments around contemporaneous and it not being in public domain, so that when this travels up to ITAT or High Court or whatever, you have taken all the arguments at the lower level.
But will that be a sufficient argument that you don't have that?
I think,
for example,
what we can do is, since we have a lot of slides to cover, we have a last 10 minutes
Q&A.
Q&A. We won't be able to finish all the slides.
Okay, what is the, we forget to ask, what is the cutoff time for us?
I think 5:30 minutes.
5:30.
Yeah.
Or we'll take it offline.
Sure. Thanks.
Okay, so when you are doing an analysis and external cup is not favorable, what are the different things which you can consider? You basically may want to see that those products, for example, it can come in whether the patents for the products have expired or they are still there, because your product may be a patented product and that is why it's demanding a higher price. You can also have independent reports, differentiating the particular quality of that product. Selling price and market share analysis, for example, you can try to show that your import prices are higher, and which is because of the quality being higher, you are able to get a higher selling price, you are getting a bigger market share. Again, we can again take the example of Crocin. So we never talk about the paracetamol. Whenever you have a headache, you just go and ask for a Crocin. So the brand value of it is so high and the market share is so high that you really don't think about that it is actually a paracetamol which you are having. You wouldn't go to the chemist and ask for anything else. So the market share and the selling price is demanding a higher price. Maybe other paracetamol is available at half the price or 10% of the price, but you couldn't actually even bother to look at that. You can evaluate upfront whether there are any internal curves, like your foreign company which is selling these APIs actives to you is also selling it to any third parties. There can be other adjustments which can be done versus what has been your R&D cost or what has been the difference in the quality and all those things. There could be a comparison that though we are importing this high quality API, you can try to show that what has been your price over the past 5 years and all that, to show that though the selling price has remained constant or changed, we are still importing at the same price. We need to understand what is the group's policy, why are they selling at a particular price. You may also try to do something analysis like whether you are under a licensing agreement and the other person is not. So very briefly, in a licensing agreement, the scenario would be that you are given a particular active or a particular API only with a commitment that, and you are also given a brand, let's say, along with that. So there is a typical case of Glaxo which says that the Zantac brand was given, and the ranitidine, which is the main molecule in ranitidine in that particular tablet, was also given by the overseas company. Now the overseas company wanted you to sell under that particular brand, and they also insist that to sell their product you have to import the API from them. So they don't want their brand to be diluted by allowing you to buy the API from anybody at any price. So that kind of an arrangement also can be shown if it is there in existence, or some other arrangement which is there with the, apart from just import, what are the other arrangements around it that you have with your overseas AE. You can show that this particular product which you are importing is not comparable, and hence you have to use transaction net margin methods and all other reports that you have for the particular API which is being imported. The next transaction which we look at is the payment of commission. So this is typically when these Indian pharmaceutical companies have marketing subsidiaries or marketing arms overseas where they are actually exporting products. So the overseas company are only marketing their products, and the Indian company is paying them a particular marketing commission. So the Indian company is manufacturing the formulations. The distribution of products is done by them outside India also. The overseas company is only marketing their products, So all the permissions and the regulatory approvals which are taken is done by the Indian company in the overseas jurisdiction. Like a lot of Indian companies, they go ahead and they set up small offices and subsidiaries abroad, like in South Africa or Brazil, or these countries where there are not too many developed pharmaceutical industry, and they take the regulatory approvals and they try to sell it there. So this overseas company basically get paid a commission on whatever sales they generate. What are the typical issues which come up in that? That if the commission percentage is, let's say, more than 3 to 5% and all that, the transfer pricing officer typically insists that the commission should be separately evaluated, okay, and it should not be forming a part of other transactions, so you cannot club it with other transactions and all that. They want you to show evidences that you have actually your sales has increased in that country, and say for example you're paying a fixed remuneration to the overseas subsidiary. They want you to show or demonstrate that the sale is really improving and the sale is increasing in that country. What kind of documentary evidences can you have in place? You can have your marketing material or letters which are written to the overseas AEs, which for explaining the strength of your product, or what kind of agreements, or you could also show what are the benefits which you are getting because of this particular marketing efforts done by that company. You can show that the sales is gradually improving in that country, and you can show what kind of marketing support you are giving to that company over there. The next transaction which we are touching upon is the clinical trial support services. So it is important to understand that clinical trial services and clinical trials are different from clinical trial support services. So in a clinical trial support service, what happens is you have a parent which is manufacturing a lot of these products and all that, and India is a center where a lot of clinical trials are done. Typically there are contract research organizations, which is CROs, or hospitals which perform clinical trials. Their subsidiaries in India, the Indian companies actually do not perform clinical trials. Their work is to just go and identify these hospitals or these doctors and these contract research organizations who do clinical trials. And what the Indian company does is it's acting as an intermediary, or it is coordinating between the overseas company, which is the manufacturer, and the local hospital or the CRO who is doing the clinical trials. So what happens is the Indian company is just the coordinator or the facilitator, and they should be paid a very minimal compensation for this. So because they are not carrying out any high-end activity, the people who are employed to do this kind of coordination are also not very highly qualified people or doctors, or any PhD holders and all that. What the typical issues come up in this is, let's say if the Indian company is typically getting a cost plus 10% or 12% margin, the transfer pricing officers, they confuse this with actual performance of clinical trials, and they try to pose a higher markup for these services. What happens is when you are identifying comparables in these cases, it is sometimes difficult to identify whether a particular clinical research organization is doing it, for somebody on as a captive, or they are doing it, for their own parent. So when you look at a particular comparable, it is difficult to bifurcate between that. So that is where challenges are faced. And there have been cases where the transparency officers have also demanded that there are certain pass-through costs. Like, you provide some kind of software, or maybe, some database which to the clinical research organizations for them to key in the reports or the output of a particular clinical trial. And these are only, off-the-shelf softwares and all that. And these are pass-through costs. But these are also sometimes considered as cost, and they are, to charge markup on that and all that. So what kind of documentary suggestions are there on this? It will have to, they have to be demonstrated that you are just a facilitator or a coordinator and do not have any responsibility for the success or failure of a particular clinical trial or a completion of a trial, in a certain period. If there is a failure and all that, you do not assume any risk. The risk is of the overseas company from whom you are coordinating on their behalf. The third party costs and all are the costs which you are not bearing. It's just, you are actually taking those services from a third party vendor, and it's just a pure reimbursement. So the main challenge over here is how do you show that you are dissimilar to a typical clinical trial organization. Next is marketing intangibles. So
given all the challenges that we face for identifying comparables for a clinical trial support, what would be the line of, what would be the search strategy that you would really go for? Would you then expand to functionally comparable, say, other business support services, or you would try to stick to clinical support?
So for clinical support, I think you can just take, typical support service providers, which are either business support service providers or administrative support service providers. But for clinical trial organization, you typically see that these, there are these very typical comparables like your Vimta Labs and Syngene and all, they actually perform. So you know that these are research organizations.
For the support part.
For the support, you do not take these. So you have to compare it with, very low-end business support service providers. So there, I guess, as we say that when we do a TNMM, it's not important to see exactly the transaction is same, but the functionality should be same. Coming on to marketing intangibles, so just broadly discussing the two types of intangibles which may be involved in a pharma industry would be trade intangibles and marketing intangibles. So very briefly, we've discussed what is the difference between these two. Trade intangibles would be things like your patents, know-hows, designs, formulas, models and all that. Whereas marketing intangibles, when we talk about intangibles which are developed over a period of time through your interaction with the customer. So the brand or the particular the goodwill of their company or the goodwill of the brand is improved through constantly being able to provide high-end or high-quality products. Marketing intangibles would include trademarks, trade names, and those kind of things. They can, as it says, it also can have certain unique names or unique symbols, and also if you are looking at advertisements. So marketing intangibles are typically intangibles which are resulting out of your advertising and promotion efforts. So if you're doing an advertising with a particular symbol or a particular sign, then that is what is registered in the customer's mind, and that becomes a marketing intangible.
Customer-related activities.
So any customer-related
Would
activity
it
would,
include a customer database also, or?
yes, it would include a customer database. So what are the issues which are faced is how do you determine, arm's length compensation for a marketing intangible? What happens when more than one party contributes to development of a marketing intangible? What part of A&P expenses constitute marketing intangibles? We've had a lot of litigation recently, and there are these cases coming out, which is LG and Sony. So we'll discuss about that in the slide later than this. We have to try to find out whether the Indian company, which is, let's say, a distributor of product, even if he's not the legal owner, he's developing a particular intangible, whether he's paying royalty. So what happens is the transfer pricing officers say that this particular brand was not known in India, and you are the one who's developing this brand, so you should not be paying any royalty. Instead, you should be getting a compensation from your overseas company because you are spending a lot of money on advertising this particular brand. The TPOs adopt a cost plus, assuming that normal A&P that more than normal A&P expenses have to be reimbursed. So this is the case what happened in the LG Electronics ruling, when the ITAT had decided that if you are incurring excessive A&P expenses, then you are supposed to be compensated by your overseas parent. They have to reimburse the excess along with the markup, because this particular excess spend is actually provision of a service to the overseas AE. So the brand building was constituted as a provision of service. What documentary suggestions we can have for that is you need to have very well drafted agreements and which are documenting your business strategy. You have to show that the marketing in India is routine and it's not. So for example, the difference is the marketing in India is towards increasing your sales, that is promoting your sales or promoting the brand. So you can always show that we are doing this advertisement only for this particular product, and this is only increasing my sales and it is only helping me to improve the sales or increase the sales and my profits. You may also have some kind of an agreement with the overseas company where they say that if you spend above a certain amount in advertising and promotion, they'll reimburse that amount to you, so that can be shown. So I have taken the example of two important cases over here, and we have tried to do a kind of differentiation as to what was different in these two cases. I'm not sure you know. So the LG Electronic case was where a special bench of Delhi Tribunal was set up, and there were about 18 taxpayers who had applied together to this particular bench, and the Delhi Tribunal had given a verdict that if a particular company or a distributor or a licensed manufacturer is incurring expenses over and above the bright line test. So very briefly I will explain what is the bright line test. What they do is they take the A&P expense to sales ratio of the taxpayer's company, and they compare the A&P expense to sales ratio of all the comparables that you have selected, and if you are spending more than the comparables, the excess what you are spending is considered to be the non-routine A&P spend, and the transfer pricing officers or the tribunal has insisted that that excess is brand building, which is provision of service to the overseas AE, and that should be recovered along with the markup. Okay, that was what was the verdict in LG. So they used the bright line test. They tried to consider what was the non-routine A&P expense. They asked the assessee that they have been doing a provision of service to the overseas company, and that should be recovered along with the markup. Now these people then went to the High Court, and the High Court came out with a ruling. Again, there were a lot of parties to this. Before we go on to the Sony Ericsson thing, there is a difference between LG and Sony and what verdict has been given by the High Court. LG was typically a licensed manufacturer, in this ruling, there is a lot of confusion whether it applies to distributors or licensed manufacturers. But in Sony Ericsson, they have clearly given a ruling for distributors only. So it is very important to understand that the Sony ruling, you have to look at it vis-a-vis distributors. and not licensed manufacturers. So in Sony, what happened is, the similar kind of cases went to High Court, and the High Court gave a verdict. So the first, so we go by the issues now. So the first issue over here was whether this AMP spend is construed as an international transaction in the first place. So typically when you do an advertising spend or you do a marketing activity, what you do is you actually are paying to these vendors or advertising agencies in India itself, right? So anybody could have a question is, when I'm paying to third parties in India, how does my AMP expense become a international transaction? Because I'm not having this transaction with the overseas AE. So what the court is saying here that yes, it is an international transaction because this evaluation of this transaction of creation of marketing intangible is happening or not is happening vis-a-vis the AE from whom you have actually taken the brand or the trademark, and you are or are not paying royalty for that. So here they are not examining the payment of expenses to the third party vendors or the advertising agencies which you have. They are examining the kind of brand building and that you are doing, which brand or the brand which is legally owned by the overseas entity. So they have made us clear in both these judgments that yes, we are analyzing this part, this leg of the transaction, and it will form an international transaction. There is no doubt about it. The second question was whether bright line test is a tool or a method to bifurcate expenses into routine versus non-routine. LG Electronics definitely upheld this, that yes, you should use the bright line test. However, the High Court has ruled out saying that there should, this bright line test and all that is not basically a part of any of those prescribed methods, and it should not be used for segregation of any kind of routine and non-routine expenses, but they have not given any clarification as to then how do you identify a marketing intangible. Whether AMP expense is a brand building service, what LG has said that incurrence of non-routine expense constitutes a provision of service which is brand building. This kind of concept has been rejected by the High Court. So if you see, the High Court did accept that this is an international transaction, but the methodology which was used by the tribunal was rejected by the High Court. What they are saying is whether it is possible to aggregate the transaction. So what happened, in some cases where they had very good profits at the net level, but still if their AMP expense ratio was higher, the same was being construed as provision for services and there had to be a particular compensation. But in the case of Sony or the High Court, the way they ruled is that you have to aggregate all the activities. So when I'm doing an AMP spend, I'm doing it as a part of my distribution activity. It is not separate from my overall activity of distribution. So even if I'm making higher margins, that is, if I am being compensated by way of, let's say, lower import prices, or I am making good amount of margins and all that, then it should be looked as an overall. AMP cannot be benchmarked separately. It has to be benchmarked with all other transactions together. So aggregation should be done. Whether set-off is permissible. So as a corollary to what I just said, that the special bench, that is the tribunal, said that the AMP function is separate and it should be compensated for even if you are making good margins, and there should be no aggregation or set off of let's say lower import prices and good recovery on selling prices and all that should not form a part of it. Whereas Sony came up with a thing that 92.3 does not. 92.3 is a section which says that if any particular transaction in your books of account has an impact of reducing your profits or increasing your losses, that should not be, to those transactions, transfer pricing regulations do not apply. So that was an argument made by the department, but the High Court said that it does not stop you from actually taking your activity as an overall and seeing that you are able to net make a profit either by reducing your import prices or making a better realization because you have a particular brand and you are able to sell at a higher price. So all these factors should be considered, and 92.3 does not restrict that. Whether the concept of economic ownership on intangibles is a reality. Now, what is economic ownership? Very briefly, I will just touch upon that. For example, the foreign company is the owner of the brand. The brand is actually registered in the name of the foreign company. What happens when an Indian company is creating, is actually selling their products in India under that brand? The Indian company is also spending money on advertisement, marketing and all that. So gradually the way it happens is that those products become popular in India and the Indian company is an economic owner of that brand. So what happens is, if suppose tomorrow the Indian company is a distributor and let's say the foreign company decides that I'm going to stop allowing you to distribute my products, I'm going to appoint some other person. What happens is the Indian company has built up, has spent so much amount that they have developed a kind of an economic ownership which they have a right to be compensated for. So they say that I have spent so many years in making this brand, for example, Crocin. It would have been sold in US as Crocin, but initially in India nobody knew it. But this company has taken so many efforts and made it so popular in India. Now tomorrow if they're going to stop giving them the distribution rights, this company has a right to then, claim certain expenses on that. But till the time they continue to do that distribution activity, they will be the persons who have the right to claim any kind of benefits which arise from the economic ownership. So the exploitation of rights on an economic ownership they can continue to have till they continue to have the distribution rights.
If the economic ownership is recognized, in case the legal owner of the brand sells the brand to some other person, whether the Indian authorities would be justified in demanding that a part of the capital is from the economic owner?
Yeah, so in this situation what will happen is, for example, the foreign company, they sell the brand. Now they may continue to have, the Indian company may continue to have the distribution rights. In that case, the Indian company may not be entitled to any kind of compensation. But if the foreign company has sold the brand and the new company which is owning the brand is going to stop giving the distribution rights to this particular Indian company, so that is going to be a loss, and that amounts to a one-time payment would be asked for. So typically a one-time payment should be made to the Indian company if the distribution rights are then given to somebody else, because they have already developed that brand and they have the right to gain or claim those kind of benefits from exploitation of that brand. So the new person who has bought that brand may decide to continue having the same distributor. Then the question of change in economic ownership does not arise. Whether selling and distribution expenses, so both these cases they have said that the selling and distribution expenses are something which are relating to sales. So your selling commission, anything which you pay to the market, to the entire market force which you have, which are post sales expenses, should be excluded from the calculation of the A&P ratio.
Yeah, because ultimately, see the Sony incident is that way confusing. Yeah, ultimately, at the bottom line, whether the court has recognized PNMM, if on PNMM I am having a good markup or good profit, as in the case of BMW. Whether all these considerations come, then whether PNMM doesn't become the final benchmark.
So what the court has said in case of the High Court has said is that the overall activity of the company, so assuming that you are the distributor and this is your only activity, the overall, all the transactions which are closely related to this particular activity of A&P should be considered. For example, if you are able to benefit from lower import prices, or if you are able to benefit from better realization from sales, then all this will actually go towards adding to your profitability even if you have an higher A&P expense. Because of the brand, you may be able to demand a much higher price in the market. So the High Court ruling has said that yes, like BMW, High Court is exactly on the BMW ruling and they have quoted BMW also in that. And they have said that you should look at the overall activity along with all closely related transactions, not only the A&P transactions separately. Whereas the LG in the special bench has said that A&P should be looked at separately, irrespective of whether you are making profits at the net level.
So it's a contradictory.
So yeah, so basically High Court has overruled what LG has been decided, except that they have stuck to the ratio that yes, it is an international transaction that they have agreed with.
But didn't the Casio ruling come after this?
Casio was on the line of BMW.
Yeah.
Yeah, so basically all those rulings which Delhi Tribunal gave after BMW followed the BMW, and even the High Court follows BMW. So see here the major difference.
Sorry, I beg to differ on that. So there is a slight difference in the BMW and the High Court decision. Fundamentally, if you see very macro level, it's fine. But if you see the wordings in BMW, what was argued was that when I'm importing something, my marketing intangible related stuff has been adjusted there, and therefore that is reflected in my margins.
Yeah, the margins, you are getting a
Yeah.
higher margin, so you are already being rewarded for that extra AMP which you have.
Correct. So to that extent, the High Court is aligned to BMW. However, it does not emphasize on the fact that your import price etc. has been adjusted, because BMW in fact is going through. So while on the transfer pricing side, they have argued this matter and said that if the margin is there and therefore it is fine, but the revenue secretary, the department representative, who was Mr. G.C. Srivastav, he has forwarded the documents of BMW to customs. So BMW is facing another challenge now, because in the BMW decision what they have said is that this pricing is adjusted in the import price. So therefore now the customs is saying that you have undervalued.
Okay.
Whereas High Court is going more by the functions, like she explained, to say that okay, if you are a distributor, then as a distributor, one of your interrelated functions is marketing, and therefore distribution plus marketing put together, if you are earning the margin that a comparable is earning, then you don't need a separate compensation for it.
Yeah.
But it is very important how you argue this AMP issue, because if you link it to the price, you can actually have, while on the transfer pricing side there is no issue, on the customs side you could have a big issue. And that's live going on.
So Karishma, suppose the P&M margin is not comparable, then in such a case, the addition will be with reference to the P&M, or will it be by applying the bright side test to say AMP?
So with reference to the TNMM. So if your TNMM margins are not adequate and you are separately therefore getting a compensated for your AMP through the bright line, then you have to follow the bright line method. However, if your plea has been that no, you are already getting compensated and therefore this doesn't need a separate compensation, then it will be under TNMM.
Since the code has recognized AMP as a utilizer transaction,
Right.
how it is to be reported? So does it mean that where do we report?
In the intangibles, in your
3CEP, I think.
Intangible clause.
There's a clause where they say that
Yeah.
any intangibles have
Yeah,
been.
I think for 5th or 6th one has that.
Yeah.
You report
So all your
goods, services.
So that's
and
the
then
thing, like the
intangibles.
High Court has rejected.
sorry, it won't come in intangibles, it will come in services. Because if you are saying that you are rendering marketing services for them, because you are
No, but
recovering
you're doing the
this,
brand building there, right? That's
but that is still a service, it is not an intangible.
it's not creating it.
Then what happened to the markup in the department was, not only the department was disallowing the excess expenditure.
So do you segregate the AMP and do a TNM on the other complete transactions and then do the AMP? How does it work?
You either do separately, transaction wise, if there are, that's an approach. High Court is not saying that it is in all cases you have to do TNMM. High Court is saying that if you have done TNMM, then that is also not incorrect. So what BMW said in terms of the margin, to that extent the High Court is accepting to say that,
No, but I'm saying suppose your TNM shows that you are getting a return of 10%.
Right.
Well, the comparables are say 12% or 14%. Then what do? You do a TNM for all the other transactions and do a separate study for the AMP.
No. If you are combining AMP as TNMM, you do only TNMM. Then you don't do a separate
No,
AMP.
if you're not,
Then you do a separate AMP.
Yeah, you do a separate AMP and TNM for the rest of the transactions or whatever is suitable.
Correct. But why would you do that? Because today actually that is the plea that all associates want to take. That ultimately whatever marketing expense I am incurring for doing business in India. And if that is one of my functions and I am getting compensated for it in the margin, then why do I need a separate compensation for that?
No, but in that case, as you said, BMW is facing.
But if you restrict your argument to margin, then you're fine. If you say that no, this has been adjusted in your import price, you're getting a favorable import price, then you'll have a customs issue. In the case of BMW, there is a specific reference to it being adjusted from the purchase price. And which is why that point was picked up and put up to you.
If you are getting a commission, if it's a slightly higher commission because you are also taking care of the marketing activities, I mean, okay, it's not exactly a reduction in price of the product, it's a commission which you get separately.
Yeah, it's the same issue, like since you mentioned this and we are talking about pharma, it's the same issue of today when you are importing your active ingredients, right? One can also take a plea that when you are saying that these APIs have R&D, etc., the plea that has been taken in the case of Sardia and in the case of Glaxo, Canada, etc., is that there is an inbuilt royalty element in the import price. So ideally, you should have, from a customs perspective, you may be fine because you are showing a higher price. But from an income tax perspective, there is a leakage because you are not paying withholding tax on the royalty, and neither are you showing the royalty income of the foreign entity as taxable in India. So that is in fact an issue. So you have to be very careful in your these interrelated arguments. You know, when you say that in an import there is an inbuilt element of a function or an R&D, etc., then you could be hit on the other side by the income tax department to say that okay, that means your import price consists of R&D and that is a royalty element and you should have ideally shown that separately. Same argument like in marketing intangibles.
But that royalty argument has been rejected by the tribunal repeatedly. The telecom case.
In the farm.
If we research and development royalty element is inbuilt in the product, then it can't be taken. Only if the royalty is paid separately.
But wasn't there a recent ruling, some software company, I think Reuters or Bloomberg or something, I think there was a ruling that said that you have to deduct PDS and everything.
Okay, so see, it's industry specific because I tell you for pharma, R&D is very crucial. And when you are on, you know, the major issue in this import of active ingredients is that you're comparing it with generic. Now you are saying why can you not compare with generic because they have high R&D. That means ultimately you are talking about the know-how of the API. And that know-how element, that means why don't you then charge me an import price and for the balance charge me a royalty?
But know-how is built in the product. That is what it was in the case of a telecom product. Every IT product we import, there was lots of software.
Right.
For which the manufacturer has paid to the know-how supplier. But that royalty can't be charged, brought to tax in India. So what we are importing is not the know-how, we are importing
In that case, it's different for hardware because the software might be developed by someone else. The parts.
The argument is right. I would tend to agree with the assessing. I would tend to agree with the tax department that if your major plea has been that has R&D and know-how, then to what extent? And if you're talking about license agreement and all, then you make an adjustment to the price to that effect. But your pricing difference cannot be 20 times or 100 times. Because today if you see a branded company may import at 100 rupees and you get a generic for 10 rupees. So are you saying 90 rupees is the differential of the quality? You know. So actually one should not go with that line argument at all. One should say that the products are not comparable and tough fails. Because the minute you go into the argument of whether there is R&D, there is royalty, there is know-how, you know, it will take you only into a kind of a double whammy. It is better to say that for cup under the law the products have to be safe, and you demonstrate to me that the 133.6 data or the secret comparables that you are using, the product is same.
But see then, if it is a paracetamol or vitamin B12, any such thing which is a common cancer drug, then how can you distinguish between the two products and say that they are not comparable?
So the shelf lives are different for the products. So sometimes you have generics which are only 2 years, whereas you have your imported products which are 3 years. Now having a 1 year additional shelf life could have a completely different impact on your profitability and your distribution strategy. Second impact is your side effects. So it is unquantifiable. There is no study in the world which shows that if you take this drug you will live for so many years and if you take this drug you will live for so many years. So there is no such study conducted. But it is a proven fact that different Drugs are available at different price points for patients, different affordability situations. So today if you go to a doctor, he will prescribe to you, he will give you an option and he say, okay, if you can afford then please go for this is the best, but at the same time if you go for this also there is no problem. But there is a technical difference in the product. And which is why you have so many US FDA rejections of Ranbaxy and all. If you see the amount of news articles that is taking place, not to say that all Indian pharma generic companies, if you see on the other hand Sun Pharma, they have some of the most blockbuster oncology products. They may be even better than your other oncology imported products. So it's case to case, and which is why it is not a commodity industry. In pharma, you are not talking about commodity. You are talking about a research know-how product. You are talking about a product with slight variation can change. It's not like an oil or a seed where they are traded on the stock exchange and you can use a cup method.
Just like the product business is so technical, some issues come. How do we understand as chartered accountant and a lawyer the product differentiation? How to communicate it to the TPO?
Take the business guy before the TPO.
Yes, you should be able to take a business guy who understands the product. Beyond the point, they can explain it to you, but I guess you will have.
They have also started understanding.
So that's okay. So because now with years, you keep doing this industry, so we can explain. But in case if you cannot understand, and initially we did that. So we had a successful DRP in one of our pharma cases, where despite of Sardia being there, we were able to get a clean order from DRP, which is Mr. Akhilesh Ranjan, Sangeeta Singh bench. We had 3 detailed hearings on this matter and they gave us a favorable ruling because we took all the relevant business people to explain to them. Right from their medical literature guy to their marketing guy to their guy who does R&D, and we try to explain to them that it is not so simple as you understand that paracetamol versus paracetamol. And of course in the facts of our case, we had critical products also, which were diabetic, which were cardiac, which were oncology, where of course even slightest of a difference, what happens is when you take the drugs, these all drugs are taken for 15-20 years. So you consume them on a regular basis like diabetes, etc. Over the long term period you could have huge impact. Even if there is slight variation in the drug which makes your quality of life better. So all these points we explained. They did their own research, they spoke to their doctor friends, they understood, they actually wrote a very detailed order to say that you cannot use cup or you need to make adjustments. And making adjustments is extremely difficult in this situation. How will you make an adjustment? But it's a very interesting thing, and in fact Sardia High Court case is yet to come up. See, this whole issue started because of Sardia. If you see, there was UCB case which said you cannot use cup method, and then Sardia came which said, so UCB said you can't compare Chinese products with European products. Then Sardia came said that no, there is no difference in the market share. To the customs authority, you have said you have reduced your import price because you are facing competition with generics. And therefore, you are yourself admitting that your product is not unique to the customs, so now you can't take a different position before income tax. So Sardia threw a complete different angle. I'm sure we see a lot of cases in this. Sorry to, I think I've anyway covered some 6-7 slides of mine. So.
Yeah. Okay, so going on to the next contract R&D, basically it is very difficult to identify whether a particular organization is doing contract research and development or it is actually participating in research and development with the overseas company. So I will just move on to the next slide, which explains the circular number 6, which had been issued by CBDT last year. So what they said is you need to identify whether a particular company in India is doing contract R&D, and if it is contract R&D, they can simply get a cost plus remuneration. Whereas if this company is participating in the research, taking risks, and also basically taking part in the strategic discussions and strategic decision making and all that, then you cannot term this company as a contract R&D. And this company would be termed as a research organization itself and would be required to have higher margins. I've just like to put this circular number 6 in a particular format. So if you see the parameters which have to be looked at in bifurcating between contract R&D and entrepreneurial R&D company, the functions which where it is a contract R&D company, the foreign entity performs all the economically significant functions like the conceptualization of the design of the product. They take all the strategic decisions. They give directions to the Indian company, which only follows the directions. About funding, capital, significant assets, they are all provided by the foreign company. Indian company always receives a cost plus remuneration. Supervision and control is done by the foreign company in factual. So it should not only be on paper, but actually it should be proved that the foreign company is supervising and controlling the activities of the Indian company. The risk profile in the sense of economically significant risks, in the sense that if the particular research process fails, so all the cost which has gone into the research project is not going to be borne by the Indian company. The Indian company will continue to be reimbursed at a standard rate of profit, whereas the foreign company will bear that loss. And the outcome of the research, Indian company would not have ownership to any of the IP which is generated. The foreign company will be the legal and the economic owner to begin with for the particular IP which is developed as a result of the process followed by the Indian company. So we have made an arrow that if all these parameters are met, then you are a contract R&D. If not, then it can be constituted as an entrepreneurial R&D or a cost sharing kind of a situation. So this is briefly how circular number 6 has explained how to bifurcate a contract R&D from an entrepreneurial R&D. What are the typical issues? We quickly run over this. What the transfer pricing officers try to claim is you are not only a contract R&D center, but you are doing full-fledged R&D and you are taking risks, so you should have a higher markup. Indian R&D center is considered as an economic owner. What they try to claim is during your process of research and all that, you have developed certain products, so the IP or the skill sets lie with the Indian company, and they fail to actually recognize that the entire work is done under the supervision and control of the overseas company. So sometimes there is factually the case where the skill sets and all that lie with the Indian company and they actually come up with very innovative products and solutions. So in that case it becomes difficult to prove that the Indian company is only a contract R&D service provider. So if they have those high level of employees which are able to generate and innovate new products and all that, sometimes it becomes difficult. So in the documentary evidence, as we have then spoken about, it is very important to be able to demonstrate that the Indian company is only working under the supervision and control, all the strategic decisions, all the innovations and all the guidance is given by the foreign company. Any kind of loss which occurs in the research is borne by the foreign company. Any kind of IP which is generated is also going to be owned by the foreign company. So this is most important in the documentation part. The next transaction is royalty payouts. Royalty payouts are basically charging off a royalty or a licensing fee when the M&E for use of valuable know-how or a process or trade name. Tax authorities are challenging these kind of royalty rates, comparables and arm's length prices as determined by the taxpayer. What happens in a royalty payment is, though there is a withholding tax in the Indian company, but the Indian company is also able to claim the tax deduction. Okay, what the tax authorities review this as a tax repatriation tool, and they try to say that this is, just a way of repatriating your profits overseas. Okay, and that is what is the issue which arises in this case. Going on to what are the issues, they try to say that you are not really benefited out of these royalty payments, and the Indian company is required to demonstrate how they are benefiting. I'll quickly go through a few cases on royalty payments because I guess we are really running short of time. So the most important case was EKL Appliances, wherein the court wherein they had paid certain royalty to the overseas company, and the transfer pricing officer had disallowed. What the tribunal said is that the transfer pricing officer cannot challenge the need of a particular know-how or a need of a particular technology which the Indian company decides to have to upgrade its systems, to upgrade its production exercise. So So that is a particular commercial decision which the Indian company should be able to take. What the transfer pricing officer can only check is the amount of payment which is made is at arm's length or not. So they say that you cannot be taking decisions, the business decisions which are taken, and as far as the taxpayer is able to prove that because of this particular technology or know-how which I have imported, I have benefited, the tax officer cannot determine the royalty as nil. He can only determine that instead of, let's say, 10%, you could have paid 8% or 7%. So that is the main thing over here. I think I will skip the other cases because they are not typically related to the pharma industry and the gist is there. We would like to cover other important topics which Karishma is taking up on location savings and other issues in the pharma industry.
Thanks, Anubhav. So this is the last issue in the pharma industry. I thought I'll take this because there was one case I argued on this issue, which is in the case of Watson Pharma. And in the pharma, that's the only decision on location savings. So the issue in location savings is basically what the TPO is alleging, that if you are doing contract manufacturing or contract R&D activity in India on a cost plus basis, then you are outsourcing work to India, and the primary objective to outsource work is also cost arbitrage. You are having a savings in the cost. So there is some location related savings because of outsourcing work to India. Therefore, whatever is the incremental profit that the group gets out of outsourcing work to India, that should be shared with India. So what is happening, what they are saying is that cost plus only 15 or 20, whatever you are doing is not adequate. In addition to the cost plus, you should pass on the incremental profits that you are earning because of this outsourcing work to a low cost country like India. Now this issue is very typical in the pharma industry and in other contract manufacturing industries like FMCG also you have some cases, but more so for contract R&D and contract manufacturing. So I will go straight to the case. So this issue is there, and so the same issue was there in the case of Watson Pharma. Now the TPO picked up from their 10K filings that was done by Watson. The listed companies, pharma listed companies will typically have 10K filings, and in the 10K filings they actually mentioned in their business strategy that they are outsourcing work, they are closing some centers in the US and outsourcing work to India. So TPO picked up this point and said that because of this outsourcing and the savings aspects and cost efficiency aspect that you're talking in 10K, you should get some additional profit. So what they did was, they said that they assumed, so of course first they asked the assessee, that the assessee said is that pharma is a very competitive industry. So I am not the only contract manufacturer in India. There are thousands of or hundreds of contract manufacturers in India, and if I don't do it at this price, they can get it done from any other company. Because the API comes from there, what I do is only formulation. So it's not some rocket science, it's not some great thing that I'm doing. It's a very routine contract manufacturing activity. And the whole reason why we, which is Watson, needs to follow this is because other pharma companies are following it, and if they don't follow it in the US, they cannot be competitive in the pricing to the customer. So what the TPO said is that, okay, if that be the case, then you let us know what is the end selling price to the customer. So he said that means that you are saying that you are passing on this benefit to the customer, so you give us the selling price of the customer to show that actually you have passed on the benefit to the customer and that profit is not residing in the US. So we said that we are not privy to the information of the US end selling price, and how are we to give that? Because if I was operating independently as a third party in India, Hyderabad, there are a number of contract manufacturers, I would never be able to ask my principal as to what is your end selling price. What I will look at is what are other manufacturers in India earning, and if I am earning that margin, that is arm's length from a market point, whether you make profit, loss or super profit, or you pass it to the customer or you don't pass it to the customer, it does not matter. So this was the arguments taken. The TPO said that no, we don't agree to this. If you don't give the data, then we will assume that there is a 1:3 kind of a cost arbitrage between US and India. They pulled out some general newspaper clippings to demonstrate that, and they said that okay, if this is your cost in India, then if you would have done the same activity in US, this would have been your cost. And he worked out what would be the incremental profit and said divided 50-50. So 50 will go to US and 50 will come to India, and he made that adjustment. Then we went to the DRP. DRP also upheld the TPO position because DRP also said that no, it is not adequate, just a plain cost plus. For location savings, you should get some additional thing. Now, when we went to the ITAT, we took a couple of arguments before the ITAT. The first argument that we took in the ITAT was to say that this is a location savings attribution arises based on the bargaining power. So if I have the bargaining power or I'm in such an industry and such a position that I have a bargaining power to negotiate with my principal, then I can command some additional profitability. And therefore we went into this theory of bargaining power, and we demonstrated that there are a number of companies in India and there are a number of companies who have US FDA approved sites who also export products to India, and therefore I don't have any bargaining power whatsoever because the intangible was with them and the market was highly competitive. So on the bargaining power theory, my location saving argument fails. The second argument that we took is we said that we had taken India as the tested party, and there are a lot of decisions. One of the key decisions that we relied on was Syscom Corporation, which said that it does not matter what is the profitability of the associated enterprise, or it does not matter in terms of what is the price that the associated enterprise is charging. What is the price that the associated enterprise is charging? So based on that argument, we said that the TPO's request is not legal and valid, that he cannot ask for what is the end price. So that is the second argument. The third argument that we took before the tribunal was to say that effectively what the TPO is doing is a profit split, because he is not applying a TNMM, he is doing a profit split. So we refer to the rules and we said in what situation can you do profit split, and the rules say that you can do a profit split only if there is an intangible in the transaction, or if the transactions are so complex and interrelated that you cannot split them. So again on that side we refer to the UN manual and the OECD manual, OECD guidelines, which say that location savings per se is not an intangible asset, and therefore relying on that we said this is not you cannot apply the profit split method. And the last important argument that the TPO had taken was that the UN manual, which is chapter 10, which talks about India related issues, clearly says that in addition to cost plus in such a situation there should be additional profit attributed. So the TPO said that the UN manual talks about this position. So what we did is we referred to the foreword of the UN manual, which clearly brings out that the India chapter is to be read differently as compared to the other chapters, and that there was no consensus by the UN members on the India and the China related chapter. Those were only administrative practices which were followed by the revenue authorities in those countries, and they were not guidelines like the other chapters. And that was specifically mentioned in the foreword of the UN manual. So we quoted that and we said therefore that is what we are actually in appeal against, because that's a practice that the government is following, and therefore you cannot just rely on that to say that it is an authentic source like OECD. And the last thing that we relied was on the BEPS report. So there is a BEPS report on intangible, which is Action 8 and 10, which again talks about the issue of location savings. And clearly in the BEPS report, it comes out that location savings is not an intangible, and in a situation like contract manufacturing, if the contract manufacturer earns a margin which is equivalent to like other comparables, then you cannot really ask for anything additional. So in that way we kind of comprehensively took all these arguments, and luckily on each of the points the tribunal decision is in favor and it completely deleted the location savings adjustment.
So you appealed?
Yeah.
Wow. It was a very good decision, especially when they said that if you've already taken local conditions into fact, then the location saving is already factored in. That was a very
So more than that point, because that particular point was covered even in the gap ruling on this issue of that if you have local comparables. I was more happy that the ITAD also went into all the other arguments like the OECD, the BEPS, the UN manual, then the competitive, the bargaining power aspect. So if you actually read the decision, it covers all those issues in addition to this margin point which is there in even gap.
No,
So
I read it in the KPMG news flash only, but it doesn't cover all these details. It was only the location.
Yeah, this is, I'm sharing it because I know I've handled it myself. So just a little bit more. But the story doesn't end here. Now I should tell you, it is interesting. So what happened is after this ITAD decision came, the TPO said that, okay, if this is what ITAD is saying, we will change our methodology on the basis of how we are doing location savings adjustment. So they actually rejected TNMM. So one of our arguments was also that, okay, you are accepting TNMM for other comparables. So they rejected TNMM and they said we are doing profit split only, and they went to prove through functional analysis, whatever, etc., that in this situation profit split is the right method. So that's another battle we'll have to kind of face, but the department has not left this issue.
But how can it be profit split? It's neither a integrated transaction nor is it an intangible. Then how can it be profit split?
So it has made up a case.
That's very discouraging, isn't it?
The concept of locational saving is embedded in the statutory law. Something is not there in the statutory law.
Sorry, so that was also one of the points that we argued. You're right, sir, exactly. So this was also one of the points covered in the ITAD to say that our law does not talk about location saving, though we did not harp a lot on it because we didn't want to see an amendment coming thereafter. So we had to subtly mention that point, because like domestic transfer pricing, you never know, they will bring some thing on location savings, But you're right, you're absolutely right on this. There is no rule of location savings in our, there is only one mention in the definition of intangibles in transfer pricing, which talks about some labor cost, human capital related aspects. But that's not purely location savings.
That's the new, those 12 points which were added in 2012 with retrospective. That has something.
Yes. So that was the issue of location savings. I think manufacturing is pretty general, right? Because I don't know, Glaxo, UCB, Surdia I have discussed. I'm sure in this course you all would have discussed about toll manufacturer, contract manufacturer, licensed, entrepreneur, I'm not sure. Have you? Otherwise I'll touch upon this slide. This is an important slide. Okay. So, before we get there, I'll just close the pharma loop. So some of the other pharma issues is this product pricing versus basket of products. This is simple. This is like in your documentation, you just need to mention if you are doing a basket of product, a class of transaction approach, then why it is important. And in pharma, it's very easy to demonstrate that you cannot have a situation where you go product by product, because if you are offering a particular therapeutic segment, certain products you may manufacture, certain products you may import, and when you go to the doctor, you need to go to the doctor with a therapy, and therefore there is a mix of products and you can't look at profitability on a product basis. So that is the argument for pharma. DPCO is another important issue that, if your end, so if sometimes what happens is a company distributing can incur a loss or a low profitability, not because their import pricing is not correct, but because of it being controlled in India. So there are a couple of products where the end price is controlled by the government. And if this is the case, then you need to make an adjustment on your selling price and rework your profitability so that this DPCO impact can be negated. And then you have your distribution startup losses. Here, all new products that are introduced, what happens is that the net profit is pretty low initially because of your high marketing expenses. So you need to do a two-level analysis. You need to have a GP analysis to say that, okay, in case of distribution, your RPM is fine as compared to your comparables. And with regard to your net level, you need to do an analysis on your gestation period. So to demonstrate that typically in a pharma, 3 to 5 years is the gestation period till the time you break even. You do that economic analysis and demonstrate it in your documentation. And there are a number of case laws now on distribution startup losses, like L'Oreal is one of them, which clearly brings out saying RPM is fine because distributor may not start making profit on day one. And then you have this issue, which is of course another common issue, is entity level versus segment level. Because if you are doing an entity level TNMF, this is effectively getting rejected by the TPO nowadays. Because they say that you should at least segment your profitability in functions of manufacturing or trading. And if you have domestic transactions, then you need to cull them out separately into a non-AE segment. So moving on to manufacturing, typically you would see that you would have about, this is not a scientific classification, but this is out of practice that we generally tend to classify in these 4 categories. One is a toll manufacturer, second contract, third license, and fourth entrepreneur. So a toll manufacturer is the least function and risk intensive versus an entrepreneur, which is highest in terms of functions and risk. And your return and your risk and reward needs to go together. So for a toll manufacturing, your compensation would be the lowest, and for an entrepreneur, the expectation would be that you earn the highest margin. So that's the funda. So if you see the chart, it's pretty explanatory. The function of the toll manufacturer is only manufacturing. Contract manufacturer would be inventory plus manufacturing. License would also sell in the domestic market, so it would be additionally sales. And an entrepreneur will also have intangibles. So that is how the chart goes up from a toll to an entrepreneur. I think FAR analysis Anuradha has covered, which is pretty much the same for the manufacturing industry. The typical compensation models that you would see across different manufacturers for a toll and contract, you would typically have a cost plus. So, or you would have a return for value added services. And in certain cases, you may also consider return on capital intensive investments if it's a highly capital intensive manufacturing industry. If it's routine manufacturing, then typically you will have a return on sales, which is your operating margin, and receipt for marketing intangible in addition to the above. Now that is again dependent on the facts, as we discussed, that you could either intermingle it with your manufacturing or you do a separate marketing intangible related transaction analysis. For a full-fledged manufacturer, you may have a profit split method which can be used, and which is typically a situation like if one company in the group does R&D and say the Indian company is focusing on full-fledged manufacturing, then India is focusing on manufacturing and another company is focusing on R&D, and therefore you may want to do a profit split method. Sorry, I've been thinking it's my phone or... So the idea of putting these issues is mainly to kind of discuss that this is what you would see the TPO dealing with in his assessment. Startup is a very important point for manufacturing. Like you have capacity adjustments. For example, you may have a startup where you don't fully occupy the capacity manufacturing, and there are a number of decisions, like in the case of Skoda, where a capacity adjustment, or in the case of Haworth, or in the case of Fuchs, there are a number of decisions on capacity where they allow you this adjustment. So it's very important that if you have capacity differences between the assessee and the comparables, you need to make those adjustments. The second is dealing with losses in TNMM. Now this has always been a challenge, because if there is a loss, then automatically, and now I think the TPOs have also got smart. So if you have tried to do a lot of segmentation, then they automatically say, okay, you've done segmentation because I'm sure at entity level you would have a loss, and vice versa, So only thing is you need to be a little careful now about the segmentation approach, because initially people were doing it on a very ad hoc basis. Now the TPO is also going into a lot of scientific questions around how you have segmented what. If you're saying actuals, they will ask you for proof. Okay, give us proof from your ledger accounts or whatever as to how you're saying the actual raw material is coming in manufacturing versus trading. Please give us allocation keys. So if you are allocating indirect expenses in the ratio of say manufacturing cost or sales, or in some cases for exports you may not have marketing expense because you're selling to your associated enterprise, then you need to line by line give the allocation basis. Because this is something which we suggest you should do a thorough job at the TPO level, because we have often seen that when this case travels up to the ITAT, the